US economy is doing far better. US Fed is still worried about inflation and they have paused. We don't know how long that pause will continue. With the entire conversation around tariffs and trade wars, that's also likely to benefit US. Interest rates are high, so capital is likely to continue to flow back into US from other markets. Therefore, this phenomena of dollar strength is likely to continue for a considerably longer period of time compared to what was earlier anticipated. And Reserve Bank can't just keep on spending reserves to defend the currency if the broad trend in the markets is one of dollar strength. So I guess this change in stance is also reflective of the new economic reality that we are dealing with, which is that dollar strength is here to stay for some more time.
A few months back, we did an episode on internationalization of the rupee, where we spoke about how rupee stability is a great strength for the currency to become international. However, over the last 2 months, we've seen a significant depreciation come through in the rupee. So what has resulted in this? Is a depreciation of the rupee good for the economy, or is it counterproductive? And what are the factors which are driving this? And hence, what are the implications and what can various entities do to manage this? This is the topic of our conversation today. Joining me for this discussion is Neeraj Gambhir. Neeraj is the Group Executive and Head of Wholesale Banking and Wholesale Banking Products and Treasury for Axis Bank. Neeraj, welcome to the show.
Right.
So Neeraj, when it comes to the rupee and the dollar, the world seems to have shifted quite dramatically because we had this period where all other currencies seem to be depreciating, whereas the rupee was very stable. And now suddenly we've seen a very sharp depreciation. So let's just start with kind of unraveling a little bit what has happened and what changed. So your thoughts on that will be helpful.
So I think if you look at the performance of any currency, the biggest driver on the performance of the currency is the balance of payments. And in balance of payments, you have two components. You have current account deficit and you have capital account flows. Current account deficit is the net deficit on account of exchange of goods and services, export and import. Capital flows is money that either comes in or goes out on account of investment activity, broadly speaking. So if you look at Indian economy's performance over the last, I would say about 12 odd months, we have actually done very well on current account front. Historically, we've been a current account deficit country. India has rarely seen current account surplus, barring 1 or 2 years in between over the last 20, 30 years. But it's the level of the current account deficit that matters. And generally, if our current account deficit is less than 2% in a year, that's considered to be a sustainable current account deficit. This year, I think we are going to be less than 1%. That's what our economics team is estimating, that probably our current account deficit this year is going to be less than 1%, which basically means that the gap between exports and imports of goods and services isn't that big. It's actually fairly narrow as compared to historical standards. Of course, we have a trade deficit, which basically means that we are importing more goods than we are exporting. And the largest reason for our trade deficit is that we are a net importer both on oil as well as gold. But we are also a large exporter of services, software services. We also are beneficiary of large amount of remittances that come into India by the overseas Indian population. The net effect of all this is that our current account is, it's not that in that sort of dangerous a territory at this point in time. It's actually well behaved, well balanced. What has happened is the scenario on the capital flows has changed quite dramatically over the last, I would say, 12 to 18 months. We have seen significant outflows from our equity markets. We were getting a lot of fixed income flows in our bond market as a result of index inclusion. If you remember, index inclusion was a big event that played out earlier this year. But even that flow has kind of tapered off, and in 1 month in between, it was kind of negative as well. So net, the capital flows have reversed. Now we are seeing capital outflows. And in order to stem these capital outflows, the Reserve Bank has to intervene in the market. And Because these are capital outflows, there is demand for more dollars. Rupee has come under a depreciating sort of pressure at this point in time. Because I would say rupee is a managed currency in the sense that we still have some constraints on, it's not a fully convertible currency. We still have some constraints on convertibility. On current account, it's largely a convertible currency. On capital account, there are constraints on convertibility. Second, Reserve Bank actively intervenes in the market to manage the currency, right? So both of these factors would basically lead to the fact that rupee is on a day-to-day basis having certain amount of volatility, but it is managed volatility. And it does feel like that there has been a change in the management of rupee by RBI since I would say mid-November this year.
Okay.
So while we did suffer capital outflows right from the beginning of calendar 2024, between let's say early part of 2024 until about October end, Reserve Bank was very actively intervening in the markets to make sure that the currency remains ultra stable. That management style seems to have undergone a change. And now, even though we still see Reserve Bank intervening, I think the intervention is more to stem the extreme levels of volatility in the market, but the absolute direction of depreciation is not something that they have stopped. It's actually now continuing to depreciate in line with the broader currency trends in the international markets. So what has changed in the last 2 to 3 months is probably the management style by the RBI as to how much depreciation they are willing to tolerate.
Right. So basically, when the emerging market pack around the world was depreciating rapidly, at that point in time, maybe it was a combination that our current account anyway looks quite reasonable. At that time, we perhaps did not have so many capital outflows as well, which then picked up subsequently. And even when the capital outflows picked up subsequently, then the central bank was intervening to keep the currency stable. And what you're saying is that now that thinking has changed a little bit.
Yeah.
So Neeraj, I mean, obviously it's very difficult for you to guess, but what could have led to this change in
this
thinking? Yeah.
If you look at it, we have in the global currency markets, I think there is a very significant trend of dollar strength that has played out for quite some time now. And let me just delve a little bit into as to why we are seeing this dollar strength. Dollar has been particularly strong against, you mentioned emerging markets. Actually, it's not emerging markets. Dollar has been particularly strong against both euro as well as Japanese yen.
Japanese yen also, yes.
Right? So both of these currencies have actually depreciated quite a lot. This relative depreciation of two of the largest EM currencies, and if you add China to it, is a function of the fact that each of these economies are doing far worse as compared to how US economy has done. In US, despite 500 basis points of rate increase by the central bank, by Fed, the economy has held up fairly well. Growth continues to be quite strong by US standards. I think even this year we are expecting about 3%, 2.5% to 3% growth in US GDP. Labor market continues to be strong. US equity markets have done fantastically well, driven by the mega 7 technology companies. All of these factors are basically combined to have a relatively better performance of both US economy as well as US markets relative to what is available in, let's say, Europe as well as in Japan. So dollar has been strong as a result of this.
And that's because of the capital flows going into the US, because the markets are doing well.
I mean, equity markets are doing well, so money has traveled out of the other economies into US.
Right. And the interest rates have also
And interest rates have actually gone up.
Yeah.
And therefore, the relative difference, I mean, you look at it this way. US short-term interest rates are currently at about 4.5%, right? Europe is still lower, it's about 3.5%, and Japan is close to zero, right? When you have such a large interest rate differential, and the economy is also doing well, and equity markets are also doing well, obviously capital has moved out of the other economies into US. And that is why you have seen a US dollar strength in recent past. But it's not been one-way street. Dollar has been strong, it strengthened, then it weakened. And somewhere around October, November, when the US election results came out, it became very clear what kind of policies the US administration is likely to follow, that has also in some senses helped the dollar strength. Now this dollar strength is, while it's particularly strong against euro as well as yen, it is also played in the context of emerging markets. Emerging markets are also not helped by the fact that the largest emerging market, which is China, is undergoing its own problems. Right? Economy is fairly weak, and even though China runs a very large balance of payment surplus, still renminbi Chinese yuan has been on the weakening path, right? So effectively, this emerging market complex has also seen that weakness.
And China actually is a even more managed, like it's actually almost a peg.
It's a totally managed currency.
And so for that to depreciate means that the government is taking a stance.
Yeah, I mean, if I take a small detour, I earlier mentioned that the performance of a currency is a direct function of the balance of payments outcome. That is as long as you have a freely tradable currency, right? In the case of a managed currency, the performance of currency is not a function of balance of payments. It's a function of how the central bank or the currency management authority, how that authority pegs the currency or moves the currency. And China is the classical case of that story. China has a very large balance of payment surplus. In fact, it has a very large trade surplus, but it tends to have capital outflows because money leaves China, partly because of outward investments, but also partly because people are taking out money from China in direct ways. So net balance of payment surplus of China is still fairly large. Despite that, the performance and the movement of Chinese currency is a direct function of where PBOC, the People's Bank of China, pegs that currency on a day-to-day basis. And they have their own models and methodologies of doing that. So China has been keeping its currency somewhat weaker in response to the fact that its economy is not doing as well. And it's very focused on exports, right?
So weaker currency helps the exports.
Weaker currency helps the exporters.
From China. Hence, by keeping the currency weaker,
yes,
they are hoping that exports will do even better.
That's right.
Which can then hopefully revive some of the...
That's right. So it's a positive for the
local economy.
For the local economy, for the manufacturing sector of China, that they are able to export, keeping the currency, at a competitive pricing. Coming back to the story of why rupee has suddenly started depreciating after a long stability. So again, it's a part of the management strategy. I think Reserve Bank did, for a reasonably long period of time, spend reserves in making sure that capital outflows do not result in a sharp depreciation in the currency, right? And probably somewhere along the line, maybe the expectation was that this, given the fact that Indian economy is otherwise doing very well, this is probably a short-term phase. And once the US economy starts weakening, the capital flows will return itself. But that has not played out. US economy continues to be strong. US interest rates continue to be high, right? And Fed has now stopped cutting the rates. So this expectation that capital flows will probably return into India, back into India, I think is getting pushed out, right? We don't know when the capital flows will come back into the economy. And in that scenario, to continue to spend reserves to keep the currency stable is a very expensive strategy. It's probably not an advisable strategy. Again, to give an example, at the peak, India's foreign exchange reserves were more than $700 billion, right? Today, our foreign exchange reserves have come down from that high to almost $650 billion. And Reserve Bank has some forward positions which are not counted as a part of the reserves of another $50-60 billion, right? So net, a considerable amount of reserve reduction has happened in an attempt to defend the currency, keep the currency stable. Part of this loss of reserves is valuation, because India keeps its reserves in multiple currencies. So when dollar strengthens against various currencies, that part of the reserves which are kept in different currencies suffers a valuation loss. Yeah. So adjusted for valuation loss, my guess is Reserve Bank has spent somewhere close to $50-60 billion over the last, I would say, 12 odd months to ensure that the rupee remains stable.
Right.
But sorry, go ahead.
So Neeraj, if we now kind of think about whether so broadly, is rupee depreciation good or bad, and hence what's the implication of the Reserve Bank either keeping it stable or not keeping it stable? So if you go there, then so one obvious implication is that if China's currencies are depreciating, and if India's is not, then our exports become less competitive. But then what other kind of angles are there to look
Well, I think it's largely to do with exports and imports.
Right.
Right. Relative currency valuation matters in the international markets. Right. We are competing with many other economies, including China, for exporting our products. And if rupee is kept stable in a scenario where dollar has seen very strong appreciation almost against every other currency. Even if rupee has been stable against dollar, by definition, rupee has weakened. Sorry, I thought
strengthened.
rupee has strengthened against almost every other currency, right? So currencies like yen, for example, if they depreciated 10-12%, rupee is actually appreciated against yen. So this relative appreciation of rupee is also reflected in what is called real effective exchange rate of rupee. In fact, a lot of commentators have talked about the fact that RER is now close to 108, which basically means that rupee is 8% overvalued compared to its normal level. So much of overvaluation of a currency is, number one, it is bad for the exporters, right? Because it makes our exports more expensive. And therefore, the exporters become less competitive, and it affects our ability to actually sell into the international markets. By corollary, it makes imports cheaper. And once the imports become cheaper, there is more tendency to import stuff than build it locally. So it discourages local production. It encourages, global imports, and it creates a sort of an imbalance in our trade. If we keep rupee strong, if rupee remains overvalued over a long period of time, we will see a steady deterioration in our balance of payments.
Because we will start importing more
Because we will
and start exporting less, because our exports are more expensive, so less people will buy it. Our imports are more cheaper, and so more we will import.
Yeah.
And hence the balance of payments the current account deficit will start looking worse.
That's right. So a strong currency effectively means that you are going to see a deterioration in your current account deficit over a period of time. Second, in the emerging market currencies, context particularly, if a currency remains overvalued for a long period of time, it can become a subject of speculative attacks, right? So people will believe that over some period of time the currency will weaken, so they will start betting against that currency in the international markets. So it can come under pressure on account of the fact that it has remained overvalued, and that can be a very destabilizing thing, right? It can create its own problems. There is another effect which is not just on the trade side of the story or on the speculative side of the story. If rupee remains stronger than what it should be, there is more tendency for people to take on overseas debt. So there is more a tendency to actually borrow in other currencies because rupee is strong. Effectively, if you borrow in other currencies and don't hedge yourself, your effective cost of funding will come down because rupee has remained stronger, right? So it also creates international indebtedness. It encourages companies to borrow from abroad rather than borrow domestically, right? So there are all these effects that come into play if you actually have a very strong currency as compared to what the fundamentals require. Therefore, it's also important that from a international competitiveness perspective, overall financial stability perspective, the value of the rupee in some senses does not, rupee does not become a very overvalued currency over a period of time. And therefore, a steady movement in line with the global trends is something that is required, which is what we're seeing right now.
Right. And the other implication, which we discussed in our previous episode, is that when the RBI intervenes to stem the outflow of dollars, so basically they are kind of selling dollars and buying rupee, they are also pulling liquidity from the domestic market, which then has growth implications because we spoke about how the money multiplier comes into force, and banks have lesser money to further lend with, and hence money creation comes down, and that has growth implications as well. And Neeraj, I guess similarly, like so let me ask the counter question: should the RBI be undervalued? Because overvaluation has so many issues. What happens when it's undervalued?
Yeah, so undervaluation, is also not a very good thing for the economy because it makes the imports very expensive. And in an economy where you're dependent upon certain imports, for example, if you're dependent upon capital goods imports for capital creation, for the new capacity creation, that gets impacted. So capital formation in the economy can suffer. So there are obviously side effects of undervaluation of the currency as well.
Also, I guess there are certain imports which are not that elastic. Like oil, as an example, you kind of need. I mean, you can kind of reduce your consumption a little bit, but there is only so much you can do, and that becomes expensive, which means that will then feed into domestic inflation as well.
Absolutely. So too much of undervaluation can also be somewhat inflationary for the economy because imports are now becoming more expensive, cost of production goes up. So I guess the right strategy, if there was one, is to say that the currency should kind of be in a narrow range around its fair value. And too much of undervaluation and too much of overvaluation can actually be a cause for problem for the management of the economy, and therefore it should be allowed to steadily sort of move in a managed currency context. In a free currency context, in a fully convertible currency context, I think the market decides and market compensates for all these things in the pricing. So that's the broad sort of story. So as dollar strength has continued, to have a very stable currency has effectively meant overvaluation against some of the other currencies. Overvaluation against these currencies is basically detrimental for our long-term health, and that's why I think some adjustment in the value of the rupee is something which we are seeing right now.
Right. And also, Neeraj, in general, the RBI's objective on currency is to basically ensure that there is not too much volatility. And, the rupee settles to some kind of market-driven rate. But then it's also not very kind of, fluctuating. So A, is that your understanding as well? And B, this stance seems to have changed a little bit, like pre-November, let's say. So what happened?
So first of all, on Reserve Bank's approach towards currency management, I think their stated objective has always been to manage the volatility. In fact, they've said that the rupee is a currency which is the value is market determined. Reserve Bank's intervention is just to make sure that it doesn't become too much undervalued or too much overvalued, and there's not a lot of unhealthy volatility in the market. That's how they broadly have been managing. Interesting aspect is that even though in years when we have balance of payment surplus, and incidentally, while we run a current account deficit, for most of the years we end up getting higher capital flows than our current account deficit. So net our balance of payment is usually in surplus. Even in those years, sometimes you see rupee depreciate. So I guess from a currency management standpoint, Reserve Bank has more focus on the relative inflation differential between us and most of our trading partners. In an ideal world, if our inflation was say 4.5%, US inflation was say 2.5%, rupee should ideally be depreciating by about 2% in a year to make sure that the competitiveness is not affected. Because we have higher inflation, US has lower inflation, our currency should depreciate. And that's what is reflected in forward premiums as well. So if you see forward premium, typically they tend to mimic the relative inflation differentials or relative interest rate differentials. Interest rate differentials should also be mimicking the inflation differential. And in most of the times, the level of forward premium is a fairly good indicator of how much rupee should be depreciating in a year's time in order to make sure that there is no overvaluation or undervaluation. It happens like that, but it is not a linear process. It's a process which has its own ups and downs. Typically, in the first quarter of a year, our balance of payment is in a far more deficit, and therefore rupee tends to have a seasonal weakening bias in the first calendar of a fiscal year, which is basically your April to June period. Typically in December to March, or rather in January to March quarter, we tend to have far higher flows into the country, and therefore that period tends to be a better period for rupee from a valuation perspective. So these trends do play out during the year, but on an average, if you see, rupee will basically depreciate in line with its inflation differential with major trading partners. Now, what has changed now? I think, like I mentioned, US economy is doing far better. US Fed is still worried about inflation and they have paused. We don't know how long that pause will continue. It's likely, it's a scenario that we might not see another round of rate cuts in US in this calendar year. With the entire conversation around tariffs and trade wars, right? That's also likely to benefit US. Interest rates are high, so capital is likely to continue to flow back into US from other markets. Therefore, this phenomena of dollar strength is likely to continue for a considerably longer period of time compared to what was earlier anticipated. If US economy had weakened in response to Fed rate hikes, probably this would have reversed. And Reserve Bank can't just keep on spending reserves to defend the currency if the broad trend in the markets is one of dollar strength. So I guess this change in stance is also reflective of the new economic reality that we are dealing with, which is that dollar strength is here to stay for some more time.
Right. Now, last question, Neeraj, which is the internationalization of the rupee, which we spoke about. One of the kind of the bedrocks of that was of an international currency is that it's quite stable. It doesn't depreciate very dramatically, and so given this, what has happened recently, how does that pan out, and how should we think?
Well, I think we should think of volatility in a currency in relative terms, not in absolute terms, right? In relative terms, rupee has still continued to be amongst one of the least volatile currencies in the world, notwithstanding the recent bout of weakness. In fact, from early November to now, rupee has depreciated by roughly 2.5%, right? This 2.5% depreciation of rupee is pretty much in line with what has happened in most of the other markets, including Chinese yuan. So in that sense, the recent move of rupee, while we keep on hearing these headlines that rupee has made a fresh low, I guess that's more of a nominal value sort of indicator. In relative terms, rupee has still been not as weak as some of the other currencies, like for example Japanese yen. So that equation of having a reasonably low vol currency is not in that sense changed that much. But we sometimes tend to forget that low vol does not mean no vol. Low volatility does not mean no volatility. Value of a currency is determined by the market. Value of a currency is a function of the underlying inflows, outflows, and the economic trends. And to have a currency not move in line with those trends will basically mean that you have a pegged currency. And pegged currency does not lend itself to becoming an international currency, right? So I guess Reserve Bank is right in terms of saying that we need to have now a little bit more volatility in the markets, and that volatility should be in line with what's happening in the other markets, and in line with our inflation trends and our overall economic trends. I would also like to say that if you have a very stable currency, it also discourages active hedging of the currency risk. It in some senses it encourages a bit of a reckless behavior, that people don't want to hedge their currency risk, because if you hedge the currency risk, it's expensive, you have to pay some money for it, and if the currency is not volatile, then that feels like a wasted expense, right? But once the volatility comes into the market, there is some value to making sure that your currency is, you hedge your currency exposure. So risk-taking behavior undergoes a change in the presence of some volatility in the market. Very hard to say what is good volatility, what is bad volatility. Only thing I would say is that probably no volatility or very low volatility is not good volatility. We do need to have some healthy volatility in the market to make sure the behavior of the economic agents don't undergo a change.
Great. So, Neeraj, what kind of I take from this conversation is that the Forex is a market. There are buyers and sellers. And depending on the amount of demand and supply, water will find its level. So, as an example, rupee will find its level. If that level is, let's say, 100, and if actual rupee value is either 98 or 102, it causes some other pressure somewhere. Either we will have higher inflation, or our growth will suffer, or something else will happen, right? Which is not ideal. So, in the most ideal situation, the rupee finds the right level. The central bank's endeavor is that as rupee finds that level, it should not be very spiky and very volatile. It should, if it is depreciating, it should depreciate gradually. If it's appreciating, it should appreciate gradually and kind of get to that level. And towards that, the recent depreciation is fine, because frankly, for a very long time, we were very, very stable, maybe too stable. And so maybe this depreciation is not that bad. In fact, it could be good. And there are many things that lead to this depreciation. In our case, it has been this constant outflow of capital. While our current account looks quite good, but there has been a constant outflow of capital now almost for 9-10 months, where more than $1 billion actually leave every month, which is driven by what's happened in the US. The US economy is doing very well. The interest rates have been hiked, and so for an investor who has the option of putting money into India versus the US looks very attractive, because that's 4.5%, as you said, whereas India is maybe 6.5%, right? So and the interest differential is more than that. So the inflation differential is more than that, and hence kind of people are taking money out, and that is kind of causing the pressure, which is not bad. And despite this, by the way, the rupee is one of the more stable currencies if you look at what's happening globally. Great. Thanks a lot for that conversation, Neeraj. I hope you enjoyed it as much as we did. Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.